US jobs growth was weaker than expected, so bonds and stocks rallied. US interest rates and the US dollar fell. All eyes this week are on the RBA for a hawkish hold. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's Chief Economist for Greater China, Raymond Yeung, looks at what a Donald Trump re-election could mean for the US-China bilateral relationship.
The impact of a higher tariff, we talk about 60% of the tariff rate, that will result in a loss of at least 0.9% of the Chinese GDP.
But first, in 5 and 5 with ANZ. Data out over the weekend showed that US jobs grew 175,000 in April, which was less than the 315,000 reported in March, and below market expectations for a rise of about 240,000. Annual earnings growth also slowed to 3.9% in April from 4.1% in March. The data reinforced views the Fed will cut this year, which meant bond prices rallied and yields fell. Bond yields move in the opposite direction to prices. That weakened the US dollar, especially against the Aussie and Kiwi dollars, which each rose around 0.8% on Friday night. They open at 5 a.m. Sydney-Melbourne time at 66.10 US cents and 60.11 US cents, respectively. Here's ANZ Group Chief Economist Richard Yetzinger on how the US jobs data was viewed.
The jobs numbers are consistent with shifting back a little bit in favour of, yes, the Fed will cut. There wasn't a lot there to really embolden the idea that the Fed will cut particularly soon, but there's enough there to say, yes, the labour market in the US economy is loosening and the next move from the Fed is going to be to take rates down.
Number 2, Richard says the US dollar is looking expensive in the medium term against the yen, even though it fell on Friday night with those lower US yields.
The 2 big macro themes really have been, when will the Fed go? Will they go, in fact, this year in terms of cutting rates? And the second, of course, has been the strength of the dollar, particularly against the yen. And those 2 things are obviously interlinked, but at various times they've each taken off on a life of their own, so the dollar's come down a bit. You wouldn't write the dollar off just yet, but if you're in markets looking at medium-term opportunities, the dollar is expensive on most valuation metrics, certainly against the yen. The dollar is expensive, and when we get some confirmation around the timing of that Fed easing, and I'm still confident the next move from the Fed is a cut, and it is going to be this year, when we get confirmation of that, I think there'll be a reasonable chance for some dollar downside.
Number 3, the big focus this week is in Australia, with the Reserve Bank of Australia's decision tomorrow afternoon, which is expected to be a hold, albeit a hawkish one. Here's Richard.
They have tried to avoid giving too much forward guidance, and I think that's wise as we go through this mid-cycle period. I've been using this expression, interest rate purgatory. Mid-cycle's a really pesky period. You can get 3 months of data that looks quite good. You can get 3 months of data that looks quite poor, but you add them together and net, haven't really moved very far. But the journey can be pretty vexing if you're too vocal about the precision of what you think is going on.
Number 4, there's still no official word yet on whether the Japanese authorities have intervened to support the yen in recent weeks. So when might we find out? Here's ANZ Head of FX Research, Marja Zaman.
It's only towards the end of the month of May are we going to get the real reveal as to whether or how much the Ministry of Finance or the Bank of Japan initially sold. That would be the day where the Ministry of Finance discloses the monthly size of intervention for the monthly period from end April to end of May. The other indicator that we will also be looking out will be sometime towards the end of the week, perhaps. The Ministry of Finance will also disclose the composition of its official reserves for end April.
Number 5, even US Treasury Secretary Janet Yellen is keeping everyone guessing on whether there was intervention or not, telling reporters that while it was a rumour, that we would expect these interventions to be rare and consultation to take place. Here's Marja Bin.
The black and white numbers are only going to come out at the end of the month, and we should just wait for then.
Marja Bin Zaman there. Now, in today's bonus deep dive interview, ANZ's Chief Economist for Greater China, Raymond Yeung, has taken a closer look at what might happen to China-US relations if Donald Trump is re-elected president.
If there is any change in the White House, that will mean a potential risk or an uncertainty, at least, for the China and the US bilateral relationship. And now economists typically, just focus on the trade impact. This is a very straightforward reaction to people's assessment of the bilateral relationship relationship in the future, or we call it Trump version 2 or 2.0. Now, because of the first version of Trump, during his first administration, we knew that he started the trade war against China. And now the trade between China and the US has already grown to another level. And China actually export more to the US. Last year, the number was $487 billion US dollar export of goods to the US. And that's contribute a lot to the Chinese GDP too. Now, if you think about during the first administration of Trump, that had lift the average tariff level to around 20%. And if he flagged that if he is taking over the presidencies again, that might even goes up to 60% tariff rate. That's enormous. And the impact will be at least a drop of 1/3 of the Chinese export to the US. Because during his first administration, when we compare the import of US from China versus other countries, we notice a difference of around 1/3, which means that these tariffs has already resulted in a decline of more than 30% of imports from China in the US. So I think this is just a minimum that we can expect. About the impact of a higher tariff, we talk about 60% of the tariff rate that will result in a loss of at least 0.9% of the Chinese GDP. So the impact on China, I wouldn't say it's huge, but this is at least a significant amount of GDP China needs to make it up by either their own reaction or some more local stimulus to make up or to close the gap of the growth momentum.
So for the last 20 years, China has been growing its trade surpluses with the United States and using the US dollar receipts from those trade surpluses to buy various assets and mostly US treasuries. So what might the impact be if we see tariffs increased and a big drop in trade and potentially a drop in the size of that Chinese trade surplus?
Let me start with a very simple concept first. We can call this factory dollar recycling. We noticed that China has been running a current account surplus with the US for decades, for so many years. Because the Chinese factory is part of the US supply chain, once they produce and then export to the US, China put the gain from the trade with the US into its foreign reserve. Now, you have had to ask that up to even 2014, the foreign reserve of China hit around 4 trillion. At that time is a huge amount of foreign reserve. And very naturally, they have to look for some asset to invest. And the US Treasury is the gold standard. In the past decades, if you ask any portfolio managers, they will have a significant proportion of their sovereign or foreign reserve put into US dollar asset. And we estimate that China is still holding 1.5 trillion US dollar of foreign reserve ends of last year. So now obviously a lot or significant proportion of this foreign reserve is the holding of the US Treasuries and also other asset-backed securities issued by either the government or the semi-government, like mortgage-backed securities. With this huge amount of foreign reserve, basically originate from a current account. If we think about in the future, the trade between China and the US or the current account surplus China can make from the US started to decline, and we have to ask the question whether China still need that much of holding of US dollar asset. Because if I don't do trade with you as in the past, at least the amount of the trade we will be doing in the future is dropping. So I need to think about my portfolio allocation, and they may be thinking about selling some of the US dollar asset. It is a very natural response and reaction, to the trade uncertainty in the future.
Raymond Yeung there. In part 2 tomorrow, Raymond analyses what might happen to the US dollar and Treasury yields. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, May the 6th. Catch you tomorrow with a deeper preview of the RBA's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.